Good day, students. Once again, I will be recording this question from of Financial Accounting 1, and we are given a trial balance. It says the trial balance of Leeway Investors as at 31st of December in the year 2006. And this is the end of the financial year, meaning it starts on the 1st of January. And is given to us below together with the additional information. We are given a trial balance which will analyze the trial balance after having read what we are required to do. I always recommend students that they should first read what is required when it comes to a big question like this question. We are required to record adjustments number 1 up to adjustment number 7, and we are to record these adjustments in the general journal. Then after having recorded them in the general journal, we have to post them into the following financial statements, which is the statement of profit or loss, the statement of changes in equity, and the statement of financial position. And I always like to highlight that it is not always required from the beginning that you must do the 3 financial statements. There might be some short adjustments or short questions that will be required before you are required to record in the 3 financial statements that are given here. So now I always recommend that don't focus on the small questions, recording general journal, ledger accounts. Don't focus on such. Mainly focus on the 3 financial statements, because that is where the major marks are. And the minute you are done with the 3 financial statements, then you can come to the short questions, and automatically along the way, otherwise, as you are responding to the financial statements, you will be responding to the short questions of the general journals and the ledger accounts that you must do along the way. And you'll see that approach. Now, I will come to my adjustments after I have done the skeleton of the 3 financial statements that I am required to do. So the minute I am required to do the financial statements, then I have to extract everything that relates to the statement of profit or loss and the statement of equity and the statement of financial position from a trial balance. Then after having extracted and recorded the rough draft, then I can do my adjustments. Now let me start recording in the statement of profit or loss. Statement of profit or loss, and it's very important that you know what gets to be recorded in the statement. Statement of profit or loss as at 31st of December in the year 2006. I think it was the year 2006 that is given in this question, or it's in the year 2000. So now we are doing the books for the year 2000, it's year 2006. For the year ended 31st December 006. We know that we start with the revenue. Then after we less expenses, there might be 2 types of revenue. Remember, we are dealing with a service entity. Less expenses. Let me check if which type of revenues do we have. There might be 3 types of revenues. Our revenue is made of, first of all, as I said to you, that I first have to record all the information that is from a trial balance. Everything that is in this trial balance, that must be recorded in the 3 financial statements. I need to copy it and paste. First record what is given in a trial balance before you do the adjustments, please. That is very important. You'll see how simple your life will be in doing the financial statements. We have rent income 12,775. We have our rent income. This is part of our revenue. Rent income 12,775. take note that I'm not writing this under total because I still have to take into account the adjustments. Then I look for another income, which is interest income, 325. There is another income, which is interest income. And I write my interest income, which is 325. There is still adjustments to be taken into consideration. So now every time you record the amount from a trial balance, just make sure that you take it so that before you do all the adjustments, you must have taken into account all the figures that are in a trial balance and have pasted them in the given or required financial statements. Then now let me deduct my expenses, and the expenses that I have in my trial balance is advertising of 600, salaries and wages 6,000, office supplies expense. I want to highlight that it is an expense, meaning when we buy office supplies, we treat it as an expense. Then whatever is left at the end of the year becomes an asset. So we have advertising expense under our expenses, and I just copy and paste the amount of the advertising, and 600. Then salaries and wages 6,000. We have wages and salaries, with the amount of 6,000. Then after we have office supplies used or expense, office supplies expense, which is in fact is under expenses 1,600. This is what was bought during the year. Then we have interest expense, or let me start with the depreciation because it's very likely that there might be a depreciation. So I just want to make provision for depreciation. I want to make provision for depreciation. Then depreciation provision that I will make, it will depend to the adjustment. Then after I can record the interest expense. Then I can record the interest expense. My interest expense given in the trial balance is 600 rands. That is taken into account. It is 600 rands. Then after this, we know that we will get to the profit for the period. Profit for the year. And this will be our profit for the year that will be recorded in the statement of changes in equity. Then I have done this, then I can do my statement of changes in equity now. Then I do my statement of changes in equity. It is very important that you memorize the skeleton of these financial statements. Statement of changes in equity. As for the year ended, for the year ended 31st of December in the year 2006. We know that there will be opening balance, and our opening balance will be made of the capital balance. We have a capital balance of 39,700. Capital balance of 39,700. Then we'll have profit for the period or profit for the year. Remember, profit for the year will be the one that comes from the income statement. Then after, if there was capital contribution during the year, that capital contribution must be taken into account. If there were drawings during the year, then those drawings will be recorded here as negative. Then after, we will get to the closing balance. We will get to the closing balance, and that closing balance is the one that will go to the statement of financial position. Now we need to tick that 39,000 that it has been recorded in the statement should be recorded. Then we go to the next statement, which is the statement of financial position. We record now in the statement of financial position. Statement of financial position as at 31st of December in the year 2006. We know that this statement starts with the assets, and our assets are classified into non-current, and under non-current we have property, plant and equipment. Then we open brackets and we look for the property, plant and equipment items. Then we have land and building that is costing an amount of 40,000 rands. So we record the 40,000 rands of the land and building. We look for another item of PPE. Don't forget to tick. Remember, this is a mortgage bond. It's a liability, a long-term liability. Equipment amounts to 5,000 rands. So we say plus 5,000 of the equipment. Then after that, we look for the investment. There is an investment in government bonds. This is 8,000 of the investment. So we also tick this investment. We assume it to be a long-term investment. Normally, investment on government bonds is normally a long-term investment. Now I want to also look for another amount that is likely to be there. Remember, equipment is a depreciable asset. If there was an opening balance of the accumulated depreciation on equipment, that opening balance will have to be recorded as a negative under property, plant and equipment. But we don't have an opening balance of the equipment, so now we leave it so far. We will calculate depreciation for the current year and minus the depreciation for the current year in order for us to get to the carrying amount of the equipment by the end of the current year. So now we have taken into account all of that. Then we come to now what we call current assets. We come to our current assets, and we know that our current assets are made of inventory. We open brackets, and there is no item of inventory in our trial balance as per yet. There is no inventory item. Then we come to our trade receivables or trade and other receivables, to make sure that we write the whole wording. Open brackets, then we look for the trade and other receivables, and we don't have any trade and other receivables. If we had any trade receivables from the trial balance, we're going to take that amount and we record it under trade receivables as the first amount to record. But we do have the bank amount, and the bank amount is 1,000 rands. So now we write the next line item and we say bank. Open brackets, we record that 1,000 rands of bank, and we ticked that. Then now we come to equity and liability. We come to equity and liabilities. First, let me write total assets, which is total assets, current and non-current. From here now we need to record equity and liabilities. This is the first step before you record anything from the adjustments, equity and liabilities. Then we start with the equity. Remember, equity is from the statement of changes in equity. We take the closing balance, but sometimes this statement might not be required. And when the statement of equity is not required, therefore now we need to show the workings that would have been done if the statement of equity was not required. So this is not always the case that you must write the statement 700 unless the statement of changes in equity was not required. In this case, it was required, but I just want to show you from the both sides of the coin. Then after we come to our liabilities, and we do have a bond, a mortgage bond of an amount of 10,000 rands or 100,000 rands, yes, 10,000 rands. There we do have mortgage bond of 10,000 rands, and this is a long-term loan. So now a long-term loan is a non-current liability. We record that bond as 10,000 here. The reason why I'm recording this bond here, because part of this bond might be a non-current. Let me write non-current. I forgot to write that. We have non-current, and under non-current we have a bond, and under this bond we write 10,000 rands. Then now we come to what we call current liabilities, and under our current liabilities we have trade payables. We have trade payables. There's a very much limited space here, but I will try to squeeze things. Then now we go to the trial balance. We look if do we have any trade and other payables. We don't have trade and other payables in our trial balance. So now if we had trade payables in the trial balance, that amount was going to be recorded here as whatsoever the figure was. But now we will focus only on the adjustments because we do not have any trade payables. Now we have recorded all that need to be recorded from a trial balance. And you must always verify that every amount from your trial balance has been marked, meaning you have ticked that amount already and recorded in the respective financial statement. So now we have recorded all that is needed to our given financial statements or required financial statements. Now I will be recording all my adjustments in the general journal. Then after I post every general journal into the given financial statement. And to simplify this, you need to be aware of the fact that in the statement of profit or loss, we record here incomes and expenses. I want to just say this. Here we record incomes plus expenses. This is where we record incomes plus expenses. So now whenever in the general journal we have either income or an expense, it must come to this statement. And whenever we have assets or liabilities, assets and liabilities will be recorded here in the statement. So now whenever we do an adjustment, we must be able to identify if the debit or the credit of that general journal, is it an asset or a liability or an equity item? Because we also do have the statement of changes in equity where we record the capital that was contributed and the amount of the drawings. So now whenever we have drawings, we need to record them here. And whenever there's capital contributed during the year that was not perhaps recorded or was recorded or was not recorded, depending to the adjustment, that will be accounted for in the statement of changes in equity. So now let me go to my adjustment. So now I will be doing general journal. I will be doing general journals, and for every general journal I will record it to where it should be recorded. We know that general journal has a debit side and a credit side. I don't normally draw the line like this. I normally just record the figures as they're supposed to be recorded. But to make sure that those who don't have accounting background are not left behind, I just want to make sure that I draw the lines in between so that we know that on the other side there's a debit, on the other side there's a credit. The first column you can have the date. I normally don't focus much on the date. I don't know why too. Now we come to the first adjustment. Now in our adjustment we are told that wages that were earned by employees. Remember, the minute you earn an amount, it means you're supposed to receive it. And these employees, they're supposed to have received salaries for the month of December, but these salaries were not received by our employees, yet they supposed to have received them. But these salaries were paid in the 2007 accounting period, very likely in the month of January in the year 2007. And whenever you are given an adjustment of this nature, you need to ask yourself some very important questions as part of analyzing the adjustment. Now, in this case, we have the amount of 400 that was supposed to be paid in December, and it was not paid in December 2006. And please be mindful that the trial balance is for the year 2006. So now that means this trial balance is at the end of December 2006. And the amount of wages, the question that you can ask, is the 400 of wages included in the 6,000 of the wages in the trial balance? Remember, these wages are for the current year 2006. Then the question will be no, because the amount of 400 was not paid. So now if the 400 was not paid, remember when I'm saying it was not paid, I'm referring to the year 2006. It was only paid in the following year, and we are doing the books for the year 2006. So now by the end of the year, the 400 was not yet paid. That means the 400 is not included in the 6,000 of the salaries and wages. Therefore, now it's supposed to be included, because this 400 is the wages and salaries that were supposed to be paid in December, or the salaries and wages that were earned by our employees or were incurred by the company, meaning the company was supposed to pay the salaries. So now, whenever an expense is not paid at the period it was supposed to be given or supposed to be paid, we call that expense an accrued expense. So now an accrued expense, we know that it is a liability. So now accrued expense is a liability, meaning the 400 of the wages was a liability or is a liability at the end of the current year. So now what do we debit? We debit our wages and salaries. Wages plus salaries by an amount of 400 rands, because the salaries were supposed to be paid in the current year and they were not paid, so they are not included in our salaries for the current year. Then after now, we raise a liability called accrued expense. Accrued salaries and wages, to be specific. Accrued salaries and wages. And we know that salaries accrued or any expense accrued is a liability. So now we credit our accrued salaries and wages. Let me then analyze the question a bit further now for recording purpose. The account on the debit side, or let me ask the question, what type of account is on the debit side? The account that is on the debit side is an expense. Very important to identify. Where do we record expenses? We record expenses in the income statement. So now first identify what type of account is it and which statement we record such account. So now meaning the 400 is an expense and it goes to the income statement. And expenses increase on the debit side, and we can see that the salaries are recorded on the debit side. That means the 400 must come to the income statement, and we say plus 400 in the income statement, so that our salaries will amount to 6,400 by the end of the current year. So now we have recorded the debit side of the general journal. Then now we come to the credit side of the same general journal, and we say what type of account is accrued expense or accrued salaries. An accrued expense is a liability. First identify that accrued expense is a liability. Which side does a liability increase? Liabilities increase on the credit side, and we can see that this accrued expense being a liability is recorded on the credit side. That means it should be increasing our liabilities. And second question or third question, which liability are we referring to? Non-current or current? This is a current liability. Which current liability? Trade and other payables. So now that means accrued expense is a liability and it goes to trade and other payables in the statement of financial position. Here are the liabilities, which is current liabilities. Then under current liabilities, we record an amount of 400, and this 400 is a current liability, trade and other payables. So now let me just look for the space to make sure that this figure is visible. So this will be 400 of the accrued expense that goes to trade and other payables. Apologies for this very limited space. I don't want to record on the second page. So now we have the 400 there at the bottom, still visible with my eyes. I hope also in the video it will be visible. So now we have the 400 that is accrued. So now that means both the debit and the credit have been recorded for this adjustment. And the minute that is done, then you can draw a line there. We are done with this adjustment, never to come back again. For every adjustment, make sure that you record in the given financial statement where it's supposed to be recorded, both the debit and the credit, so that you know that you are done and dusted with that adjustment. Remember, guys, not all the times adjustments will be required. That you must do general journal for all the adjustments. It is very unlikely that you'll be required to do such. Therefore, now that means these are my workings. All that I'm doing here is my workings to simplify my recording to my financial statements. So now we go to the next adjustment. So adjustment number 1 is done, and it has been recorded in the general journal and recorded also in the financial statements that were supposed to be recorded. Unused office supplies on hand at the end of December is 250. So now this is the unused office supplies, which is office supplies on hand. And in this case, this is an asset. Whenever we have not used inventory, therefore now that inventory of stationery becomes an asset. So now we must record this as an asset and say office supplies on hand, which is an asset. Office supplies on hand, which is an asset. Then we say the amount is 250. Then after we credit our office supplies, we credit our office supplies used. And the amount of the office supplies used will be 250. So now we have recorded the 250 both on the debit side and also on the credit side. Then again, we apply the same principle throughout. Narrations are also important. You can also narrate whenever you want to narrate. Now, on the debit side, we ask ourselves, what type of account is on the debit side? It's an asset. Or if it's an asset, then we can say, okay, it's an asset. Where do we record assets? In the statement of financial position. So now, under which line item? Under inventory, because this is inventory. So now let us go and we record the 250 under assets, under inventory, which is current asset in the statement of financial position. And we record here under inventory 250. So now that means the debit side has been recorded in the given financial statement. Then after we come to our office supplies expense or used, this is an expense account, obviously. I've already mentioned that. And if this is an expense, where do we record expenses? In the income statement. And remember, in this case, our expense is recorded on the credit side. And we know that on the credit side of an account, when it comes to expenses, they decrease on the credit side. So now this is the decreasing side of our expenses, the credit side. So now if that is the decreasing side, that means in the income statement under office supplies, we need to say minus 250 rands because expenses decrease on the credit side. And in the ledger, we can see that expenses are on the credit side. And I also want to caution you at all times of this because it is very crucial that for every adjustment, please test it to your accounting equation. I'm not going to be doing this throughout, but I want to do it only for these two. Remember, accounting equation says assets is equal to liability plus owner's equity. That is the accounting equation. Now, if every adjustment that you record, you can test it in the accounting equation, and it balances in the accounting equation, that means also your financial statements will be balancing if you record them in the right places as they're supposed to be in the accounting equation. Now, I want to start with the first adjustment that I've done. We have wages expenses here as 400. And we know that expenses reduces owner's equity, so the 400 will be recorded here. And this 400 is a liability, and liabilities will be increasing by 400. And under assets, there will be no asset. Therefore, now 0 assets is equal to 400 minus 400 will give us 0 total of the net assets. Equity and liability will be 0 because 400 minus 400 will be 0. Remember, bracket in accounting indicates a negative. So now that means 0 net of liability and equity. Then accounting equation still balances. Now let me come to the second adjustment again. Second adjustment, we have office supplies, and this is our office supplies being now in this case being an asset. And in this case now it will be a bit different difficult to record this in the accounting equation because there would have been a column now that will be provided that will be reducing our office supplies. So now this will be office supplies. Remember, this will be recorded as a negative now under the column of office supplies. For this one, I will have to draw the columns. It will be a little bit tricky, but at the end of the day, it will still balance, as you'll also see when you compile our financial statements. Now, please make sure that you test when necessary that the adjustment definitely is what it is supposed to be. Now, let me proceed on that same note. Maybe there are questions where this can be very clear, only where there are columns. If there are no columns, it will be a little bit tricky. I'll have to create columns and record all of that. Now, let me just give you clarity on this so that I don't leave it hanging. Maybe you might think, why am I not doing this? Remember, if this is an asset at the end, there will supposed to be a column under assets. And that column will be office supplies inventory. Therefore, the 250 will be negative. It will be negative 1,350. But let me leave it because it will go to the other part now that I don't want to go to it. Let me leave that one so far. It will be a confusion now, and I'll have to explain a bit further. But very important to test every transaction into the accounting equation as you are recording. Except, obviously, the inventory unused or used at the end of the year, it will be a bit tricky for that one. It's only in the accounting equation where it will be very clear. Number 3, it says that interest owing on the mortgage bond for 2006 but not yet paid. We are owing the interest for the 2006 accounting period, and the interest was not yet paid. Then now again, is the interest included in the amount in the trial balance? No, because it was not yet paid. Must it be included? Yes, it must be included because it is an expense for the current year, and expenses for the current year must be recorded in the financial statements as they were supposed to be recorded because they were incurred at the end of the current year. Now let us look at how much is this interest. We have a 9% mortgage bond out of that 10,000. Let us now say, oh, they've already given us, we don't have to be multiplying. They've already given us the amount. I'm just used to the concept of multiplication now. So now this amount was not yet paid and it was supposed to be paid. So now if it was not yet paid but supposed to be paid, then we have to say this is what you call accrued expense. This is what you call accrued expense. So now accrued interest, we know that is a liability. So now we have to debit our interest expense because this interest was supposed to be paid in the current year. And anything that was supposed to be paid must be recorded as an expense for the current year if it was an expense. So now we say debit our interest expense, because our interest expense in the trial balance is underestimated by an amount of 225. So we debit 225 and we credit accrued interest expense. So now this will be accrued interest, meaning interest not yet paid, and any expense that is not paid is a liability. Any expense that is not yet paid is a liability. So now hence we increase our liability by 225. Now again we come to the debit side of this entry and we say the debit side, what type of account is this one? It is an expense. Which side does expense increase? They increase on the debit side. So now meaning our expenses are increasing. Where do we record expenses? In the income statement. So now if you answer these questions as you are analyzing the adjustments, it will be easy for you to record. So now we must go to the income statement where expenses gets to be recorded. We look for the interest expense and we say plus 225. Then after we go to the credit side of the entry, we say on the credit side accrued interest expense. What type of account is accrued expense? Accrued expense is a liability. Accrued expense is a liability. So now a liability is recorded in the statement of financial position. Which side does the liability increase? Liabilities increase on the credit side. So now that means this amount must be increasing our liabilities, and those liabilities are called trade and other payables. Remember at the bottom there was a 400, then you say plus 225 here at the bottom. Plus 225 here at the bottom. So now we add the 225, add 225. So now there's 400 and there's 225. So now we have recorded this entry once again, both the debit and the credit in the respective financial statements. Once again, assets is equal to liability plus owner's equity. This is an expense. Expenses reduces owner's equity. 225 will be minus, and this is a liability, and liabilities will be increasing as 225. Again, asset, there is nothing. The net of the two will be plus 200 minus plus 225 minus 225. Zero assets, zero owner's equity with the liabilities. Again, your accounting equation still balances. As I said, that is preferable that you do the test throughout, except when it comes to the office supplies or stationery on hand. That is a bit tricky when you're doing the general journal. So now we go to the next adjustment and we check what do we have or what are we given in the next adjustment. In the next adjustment, we are told that equipment that was bought on the 1st of January in the year 2006. Take note the date is at the beginning of the accounting period. Then they say must be depreciated on the straight line method at 10% rate of the cost price. Now they say depreciation is 10% on the straight line method or on the cost price. That means when we're calculating our depreciation, we need to say the cost of the equipment, which is 5,000, we multiply this by 10%, it will give us the amount of 500 rands. And 500 rands is what you call depreciation. Therefore, now we need to record our depreciation where we debit our depreciation. We say debit our depreciation and we credit our accumulated depreciation by an amount of 500. So now we credit our accumulated depreciation. We say accumulated depreciation on equipment. Depreciation on equipment. And the amount is an amount of 500 rands. So now we know that depreciation is an expense. Take note of that. Where do we record expenses in the income statement? Will it be a plus or a minus? It will obviously be a plus, increasing the expenses because expenses increase on the debit side. Then now let's record our depreciation in the income statement as we have seen that it is an income statement item. Then now on the credit side, we look for the credit entry. Where do we record accumulated depreciation? We record it in the statement of financial position, where under property, plant, and equipment, that will be minus reducing our assets because they are losing value by the amount of the accumulated depreciation or depreciation of the current year. So now the 500 must be recorded as the negative under the property, plant, and equipment. So now we have recorded also that entry where it should be recorded. And again, for this one, it will be difficult for you to test it in the accounting equation because of the columns that need to be provided. So for that reason, I will also again not analyze this in the accounting equation point of view. If there was the accounting equation, then you are going to make it very clear. It was going to be very easy where columns are provided. Otherwise, now it will bring confusion to your site. Similarly, with the one on the inventory on hand. So now this is recorded, and this is recorded in the financial statements where it's supposed to be recorded. Then after we come to the next adjustment, and the next adjustment is adjustment number 5. Only 2 adjustments are left. Adjustment number 5, we are told that the rent income in advance and not yet earned. Take note, they say not earned. What does it mean? Meaning we were not supposed to receive the rent. I want to go back to the first adjustment. In the first adjustment, they said wages earned by employees. That means employees were supposed to receive these salaries, but they did not receive them in the year 2006. Hence, it said wages earned. But now it says here to us that rent income in advance, meaning we received the rent before time, and we were not supposed to receive the rent for this period. This is the rent for the next period. That is why it says rent and not earned, meaning we were not supposed to receive the rent, but we have already received. That therefore means that the amount of 300 of rent is already included in that 12,775 because we received it before time and we received it in the year 2006, yet it's not for the year 2006 but for the year 2007. So now if it's already included and it's not supposed to be there because it's for next year, therefore now that means our rental income must be reduced by the amount of 300 that is for next year but not for the current period. Why am I saying next year? Because anything that you receive in advance is not for this period but it's for the next period. Because they said rent income in advance not earned, amount is 300. So now let us record in our general journal and we debit our rent income. Why am I debiting rent income? Because I want to decrease my rent income by 300. Why am I decreasing my rent income by 300? Is because in my rental income of 12,775, there is 300 that is for next year, not for the current year, because it was received before time and we were not supposed to receive it. It was not earned. So now for that reason, we must debit incomes. Why? Because income decreases on the debit side, indicating that minus. So now we say we don't want this rent to be our income this year. It must be income for next year because it's not for this current year. And now anything received before time is a liability, or in fact any income received before time is a liability. So that means we have to say here rent income in advance. Rent income in advance, or rent received in advance. Rent income in advance. And the rent income in advance is an amount of 300. And we know that anything that you receive before time is a liability. So now we can identify that income received in advance is a liability. Then now rent income is an income. Where do we record incomes? I'm on the debit side now. Where do we record incomes? Incomes are recorded in the income statement. So now which side does income decrease? Incomes decrease on the debit side. So now if incomes decrease on the debit side, and we have recorded the rent income on the debit side. That means we must reduce our rent income in the income statement by an amount of 300. As I said, that the 300 is included in the 12,775, but it should not be included because it's not for this period, but it's for the next period. So now we don't want that income to be recorded in our income in the income statement because it was not supposed to be received or it was not earned. Then now we go to the next one. We say we have recorded the rent in the statement is supposed to be. We can tick that. And we say that income received in advance is a liability. And say current liability. And liabilities increase on the credit side. And you can see that our income received in advance is recorded on the credit side. So now that means this must be recorded under our liabilities and under our current liabilities. And we say plus an amount of 300 rands. There's quite a number of trade payables that we have there, though the space is quite limited. But as long as we are still moving despite the limitation of space and there's clarity in everything that we do. Now we have recorded the income received in advance. I want to highlight some very important things here. We had accrued expense here. We also had accrued expense here. And here we have income received in advance. Now at least we have covered two things that are very crucial regarding accounting. Now let us look at the next adjustment. If what does it have for us? Interest income earned on government bonds not yet received. Take note now. Interest income earned. Previous one they said not earned. And I said here we were not supposed to receive it, but we have already received it. Therefore we need to remove it because it's not for the current year but for the next year. In this case, interest income earned, meaning we're supposed to have received the minute you earn something, meaning you're supposed to receive it. And it was on government bonds, but not yet received. That means we're supposed to receive the 200, but it's not yet received. That means it is not included in the amount of 325 that is in the trial balance because it is not yet received, but it was supposed to be received. The previous one was received, but it was not supposed to be received. Therefore, we had to remove it. Now, the one that was not received but supposed to be received, therefore must be added because it is an income for the current year. Now, that means our interest income will be increased by 200 to say the amount of 200 is the interest that we're supposed to have received in the current year because we earned it, but it was not yet received. Therefore, it's not included yet in the trial balance. So now meaning we need to say this is what we call accrued income. Anything that is not received is, or anything that is not yet, meaning is accrued. It could be accrued income or accrued expense. In this case, we have accrued income not yet received. And we also have expense not yet paid, that will be called accrued expense. But here we are focusing on the accrued income. Accrued income. This is income not yet received. The minute they say not yet received, that becomes income. The minute they say not yet paid, that means accrued expense. Expense not yet paid. And accrued expense is a liability. And accrued income is an asset. Take note of that. Those figures or those terms are very crucial in financial accounting. Let me go back again to the wages. They said wages earned by employees, in this case, is the employees who earn the salary. We have, as the business, have incurred the salary. And they said, but not yet paid. And not yet paid meaning it is an accrued expense, and accrued expense is a liability. And liabilities will be recorded in the statement of financial position under trade and other payables, and we have done so. Sorry to digress and go up and down, but I want to make sure that there is enough clarity with regards to this concept because they are very crucial in financial accounting. Hence, I've used this question because it covers all the accruals, prepaid income, received in advance, accrued income, accrued expense. Now, we said that accrued income is an asset. So now meaning this 200 must be debited, increasing our assets. So now we will debit our accrued income. Income that is not yet received but was supposed to be received. So we debit our accrued income, which is accrued interest income to be specific. Accrued interest income, which is an amount of 200, and we have to increase our interest income because our interest income is supposed to include the 200, but it does not yet include the 200. Yet it's supposed to include the 200. So now we have credited our interest income, and we know that incomes increases on the credit side and assets increases on the debit side. So for both of these, it will be increasing and increasing. Remember, accrued income is an asset, and because it's an asset, it goes to the statement of financial position. So now we must go record there in the statement of financial position under trade receivables. Under trade receivables, we must record the amount of 200, which is in accrued income not yet received. Then after we say incomes goes to the income statement and the increase on the credit side, meaning our interest income must be added with the 200 so that at the end of the day we get to 525 rands. Now let me just minus the 12,775 with the amount of 300 so that by this time I already have 12,475, and I can calculate the total of my revenue plus 525. I don't know why I said 522, yet I said 525. So we have 13,000 rands. Then we record this as 525. 525. Total amount will exactly be 13,000 rands. I just recorded all my incomes as revenue. Remember, you can have revenue plus other incomes. I just decided not to say other incomes, just to have one revenue with all the different types of incomes that I have. I also want to now, I also would like now to take into account wages, in fact, and say 6,400 were done. Okay, 1,600 minus 250 office supplies is 1,350 that we are to record. 1,350. And depreciation, there's only one depreciation that we have. There will be no other depreciation. I just want to circle my expenses now. This will be 810.25. Then there's still one adjustment left. I'm not done yet with the adjustments. I still have to take into account another adjustment. And once again, both the debit and the credit has been accounted for. For all of them, make sure that the debit and the credit is accounted for before you can move to the next adjustment. We come now to the last adjustment. Adjustment number 7 is advertising expense or advertising cost. They say advertising cost paid is already paid. The minute is paid, that means it is already included in the trial balance unless stated otherwise. So now in this case, it's paid, meaning it was recorded at the point of the payment, and it was recorded also in the trial balance or transferred into the trial balance unless the adjustment states otherwise and say it was not yet recorded. But in this case, there is no such and such. Advertising cost paid that relate to the 2007 financial year 150. Take note, we paid for advertising, and the advertising, let me say, was not incurred, meaning the advertising is for next year, is not for the current year, meaning we paid for an expense before its time. And the minute you pay for an expense, remember, why am I saying before its time? We are doing the books for the year 2006. That is where we are. We are doing the books for 31st of December 2006. So now if we pay advertising for the year 2007, meaning we paid an advertising of next year, but we are still in the year 2006. And now when you pay an expense before time, we call that prepaid expense. We paid it before time. We paid it for next year, yet we are still in the year 2006. So now we call that prepaid expense, where we paid advertising for the next year 2007, yet we are still in the year 2006. The amount is 150. The prepaid expense, we know that prepaid expense is an asset. That's what it means. Remember, when the 150 was paid, what you would have said is to say debit advertising. I want to highlight this. We would have said debit advertising and credit bank when this entry was done and 150 was recorded. Then after this amount was added to the advertising cost and it was recorded in the trial balance. So now the 150 was recorded and is included in the 600 in the trial balance, unless they said it was not recorded. If they don't say that, meaning it was recorded correctly and it was transferred in the trial balance and it is included in that 600 of advertising the trial balance. The question is the 150 supposed to be in our income statement in the current year? The answer is no, because expenses of next year must not be recorded in the income statement of the current year. That means the advertising of 150 that was paid for next year must be removed as an expense in the current year and be included in the expenses of the following year. Now, let us record that, meaning that negative indicate that our expenses must be reduced by 150 on the credit side, and that expense being an advertising expense. Now, let us go and we debit. Remember, I said prepaid expense is an asset. So now, if we say prepaid expense and asset, assets increase on the debit side. So this will be prepaid advertising. Prepaid advertising. And prepaid advertising is an amount of 150, and we credit our advertising expense, or credit our advertising cost of 150. Remember, prepaid expense is an asset. Where do we record assets? In the statement of financial position. That is just the abbreviation. Statement of financial position. Where under the statement? Under current assets, trade and other payables, plus 150. Therefore, now this will give us an amount of 350, and our inventory will be 250, and our bank will be an amount of 1,000 rands. Then we can totalize our current assets. Sorry to do that one now. So we recorded first the debit side, which is an asset. Then we come to the credit side, which is an expense, advertising cost, and expenses decrease on the credit side. So the minute advertising was credited indicate that our advertising must be reduced by 150, so that advertising for the year must be recorded as 450 in the income statement. Now let us then draw the line to record the total of all the expenses that we have. Then we'll also take into account of all the assets that we have. Then we totalize everything and check if does everything work very well. Then we do the balancing. The bond, there was nothing else with regards to the bond. We can transfer the bond amount as it is. Then we need to totalize the trade payables, which are made of 400 plus 225 plus 300 rands. Therefore, now this will be 925 rands. And our total of the assets will give us, total of the liabilities, it will be 10,925. Now we still await for the equity part. Let me start now with the income statement, or just doing the random calculations, totalizing all the figures. Let me now come to my expenses, all of them, which is 450 plus 6,400 plus 1,350 plus 500 of the depreciation plus 825 rands. This will give us 9,525. Minus 13,000 rands of the revenue will give us a total of 3,475. The 3,475 goes straight under profit for the year 3,475. Remember, there was no adjustment regarding the opening balance of capital, so we can say 39,700. There was no capital contribution and there were no drawings during the year. Then you can say plus 39,700, and this will give us a total of 43,175. Remember, this figure, we transfer it under the statement of financial position. Under the owner's equity, this will be 43,000. This will be 43,175. Remember, if the statement of changes in equity was not required, therefore now we'll have to show all these workings in the statement, where we say 39,700 plus the profit of 3,000. If you remember, profit of 3,475. We'll have to add the profit here and to say plus 3,475. Remember, if there were drawings minus drawings, it was capital plus capital, but we don't have them. So you'll have to show the workings in the case where the statement of changes in equity is not required, so that you can get 1 mark, 1 mark. But now it will only be 1 mark. That is from here. If you copy this amount, you record it here, then you'll just get your 1 mark. That will be 1 mark appearing there, unless the statement was not required. Now we have recorded that. Then let's go to our assets and we totalize the amount of the property, plant and equipment. 40,000 plus 5,000 minus 500. This gives us 44,500 rands. And our total of the non-current assets will be plus 8,000 rands, and it gives me 52,500. Current assets, we have 250 plus 350 plus 1,000. It is 1,600 rands. Then we say 1,600 rands, we plus 52,500. This gives us a total of assets in total as 54,100 rands. So our liabilities and owner's equity must give us the same amount. Now we have the total of the liabilities. Current, we had 925, and the total of that, draw a line there, became 925. And our non-current, it was that figure. Then after, now we can say our total equity and liability. I want to write it here on top because of the space limitation. We have 43,175 plus 10,925. This gives us the amount of 54,100 rands, equity and liabilities. 54,100 rands. So now we can see that our total assets are equal to the owner's equity plus liabilities. And our financial statements, once again, they are balancing. Very easy approach. Now, I just want to highlight one very crucial part with regards to the mortgage bond. This is where I am now. Remember, with regards to the mortgage bond, they did not tell us how much of the portion of the bond is payable within the next 12 months, meaning there is no current portion of the loan. But had they told us that maybe if they said that 2,500 of the bond will be paid next year, therefore now I will have to say 10,000 minus 2,500, then the 2.5 will have to come to the current liabilities as the current portion of the loan. But in this case, we did not have any of the current portion of the loan that will be paid next year. So now the full 10,000 becomes a non-current liability. But if there was the current portion, therefore now the total here will be 7,500, and another 2.5 will have to be recorded here as the current portion of the loan. But we did not have such, then that will make things easier, or life easier for us. Guys, without any questions, I can say thank you, and I hope you have learned something that will help you in your revision for the exams in financial accounting with regards to the topic of the financial statements. Let me say, guys, thank you. God bless you. Have a very wonderful understanding.